This is question number 4 on homework 6 for chapter 6. You own a portfolio consisting of the following stocks. So just click on this pop-up window. We can see that this portfolio consists of 5 stocks, and each with the percentage of portfolio, which basically is the weight on the corresponding stock. And we are also provided with the beta and expected return for each stock. So what's cool about this table is that we can actually copy this directly in Excel, which will make the calculation much easier to do. So once we open that in Excel, we can go back and finish the setup. The risk-free rate is 5%. Also, the expected return on the market portfolio is 9%. Calculate the expected return of your portfolio. So if you look at the hint, actually my lecture slides also has the information about how to calculate the expected return for a portfolio, which is the same as portfolio expected rate of return on this page. So basically, that's the weighted average of each of individual stocks' expected returns, while the weights are the percentage invested in each stock. So now, if we go to this table, what we need to do is basically to calculate weight times the expected return, right? Expected return. And we do this for each individual stock, and then we sum them up. That's the weighted average. So just multiply the weight by the expected return for each stock. And that's why I said earlier that using Excel can facilitate the calculation, because when we calculate one product, we can just drag the cell to the other stocks, and Excel will automatically calculate the other products for us. So now I can calculate this portfolio expected return as the sum of these products, and then just follow this. The final step is just look at the rounding requirement. First, it's in percentage, and then round to 2 decimal places. So just follow that. You can just format the cell, put it in percentage terms, and keep 2 decimal places. So 17.55. And continue, what is beta of your portfolio? So beta can be similarly calculated. It's weight times beta, right? It's also a weighted average. The only difference is that instead of multiplying by expected return, now we're multiplying by the beta of the corresponding stock. So this will equal to the weight on stock 1 times the beta of stock 1. And now we can use the convenience of Excel to drag the cell to the other stocks. And then we can actually also drag this summation here to the other cell. And this is basically my beta. But for beta, I don't want to use the percentage format. I just keep the number format and just go back and check the rounded requirement. I believe it's round to 2 decimal places. That's why I kept 2 decimal places. So that's exactly what I found. So it's 1.05. And check my answer. So this part is basically to draw a chart. Given that the stocks from your portfolio have been plotted on the graph below, draw the security market line. And if we want to draw a security market line, we have to understand its feature. So security market line has to cross 2 points. Every security market line has to cross these 2 points. One is when beta equals 0, we know that this means risk-free rate, right? So the first point every security market line has to cross is that on the vertical axis, it has to cross a point that expected return equals the risk-free rate. And then the second point that every security market line has to cross is that when beta equals 1, and when beta equals 1, we know that this means the market portfolio, right? So when we have a market portfolio, the return should also be the expected return on the market. So the second point that every security market line has to cross is that when beta equals 1, the expected return on the vertical axis should be the expected return on the market portfolio. So now we can use the information provided, and with that knowledge, we can draw this security market line because we are provided with this risk-free rate, 5%, and we are also provided with expected return on the market portfolio, 9%. So we can just connect those two dots, and that's our security market line. So I use the 9 function here, 9 tool here. First point is that when beta equals 1, so that goes to our vertical axis. So going back to the setup, the risk-free rate is 5%. So the first point should be that beta equals 0, and the return should be 5. So it's right here. You can actually check this, the axis point by these two numbers, right? First one is the beta and second one is the expected return. So just going back here, so it's going to be this 0, 5. So that's my first point. And second point is that when beta equals 1, we know that expected return will be 9%. So it's going to be this 1, 9. And now this is my security market line. So save that, and now I can check my work. We're done. So part D is asking us from your plot in part C, which stocks appear to be your winners and which ones appear to be losers. So how can we judge which stock is the winner and which stock is the loser? And we know that every stock on this on this security market line should be fairly priced. By fairly, we mean that the expected return corresponds to its risk. And we know that within a well-diversified portfolio, the risk is measured by systematic risk because all the unsystematic risk has been diversified away, right? So with that knowledge in mind, and this vertical axis means the expected return. So any investor would prefer a higher return but lower risk. So given the risk, if this point is above the security market line, that means this stock is a winner. Why? Because given that risk, the corresponding point on this security market line is fairly priced, right? So given that risk, actually this stock, for example, this point 4 here, has a higher expected return. So with the same level of the risk, now stock 4 offers a higher expected return. Hence, it's a winner for us. And we can see that for this for this question, right, we can see that all these 5 stocks are winners, right? Because they all lie above this security market line. So now we can use that knowledge to answer this question. Stock 1 is a winner, right? And final check. And the stock 2 is also a winner. As we said, every stock is a winner, right? Stock 3 is a winner too. And stock 4 is a winner. And stock 5 is also a winner. But then the final part of this question is asking, why should you consider your conclusion in part D to be less than certain? So we have analyzed this problem by saying that every stock is a winner in this case, but the conclusion is based on the position of this security market line. But notice that the position of the security market line is actually determined by these 2 points, the risk-free rate and expected return on the market portfolio. But in reality, both the risk-free rate and the expected return on the market portfolio need to be estimated. So there is error associated with each input. So when there's error associated with each input, that means there's also error associated with this security position of this security market line. So that's the uncertainty we have to face. So then we just look for the answer which captures that analysis. A, the results are less than certain because the market data is not possible to obtain. That's actually not true, right? Because we have actually to estimate this risk-free rate and expected return on the market portfolio, we have to use the market data. The results are less than certain because the investor's preference toward risk is hard to estimate. That's actually not the point. The place that investors' preference toward risk, which means the risk tolerance or risk aversion, right, matters is when the how much of the risky portfolio to hold and how much of the risk-free portfolio to hold. What's the weight on each? So that's when we need the investors' risk tolerance level. But in this question, actually, that issue is irrelevant, right? Because we're basically looking at each individual stock and to say which one is winner and which one is a loser. We're actually not using any investor's risk tolerance level to answer that question. We don't need that information to answer this question. Part C, the results are less than certain because the capital asset pricing model is based on some unrealistic assumptions. This is also not true, right? Because even though capital asset pricing model is indeed based on some unrealistic assumptions, but that has nothing to do with the situation here. So that means that we have ruled out all the other 3, which means the only possible correct answer should be D. But let's confirm that's the case. The results are less than certain because it is possible to misspecify the security market line by using bad estimates in the data. That's exactly what we have analyzed. So D should be the correct answer.